You are listening to Keystone's Stock Talk Show, episode 191.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again this week. We'll start by touching on Aaron's Money Talks with Mike Campbell appearance. He will have a segment on why dividend growth stocks should be part of every Canadian investor's portfolio heading into 2023. In a Stock Talk 101 segment, Brett will give you his take on the problem of investing in concept stocks. In our Your Stock Our Take segment, I answer a question on an embattled Canadian software company, Durham, symbol DND on the TSX. The serial acquirer, which provides cloud-based software for legal and business professionals, has seen its share price drop 67% in 2022 in the tech crash, and a listener asks if it finally offers value. Finally, Brennan compares CN Rail and CP Rail in the wake of the Kansas City Southern deal. A listener asks us which is a better buy now after the dust has settled. I'm going to welcome my co-hosts, Aaron and the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well. What about yourself?
We're snowed in.
Buried in snow.
Yeah.
Snow. Yeah, I looked outside. There's like 2 feet of snow in front of my house.
Yeah, I literally measured it an inch short of 2 feet. Like that is for here in Vancouver, like we've said.
Oh, that's a lot of snow.
Insane.
You don't get. I mean, it's once every
2 inches in the city
decade or something
down.
where you get this much snow. So I remember
the
last
airport
time
is shut.
Being snowed in. It's like 15 years ago or something.
Yeah, YVR, the airport, no planes are going in and out.
Oh, really?
So
it's completely shut down. Wow.
Your wife may be
crazy.
stuck in wherever
we'll
she is.
See. We still have. They have a couple days to.
Is that a good or bad thing? I'm not
sure.
That's
a bad thing.
There is a couple kids to deal with.
It's a very bad thing.
Yeah, it's true.
No, I'm sure it'll be fine. She's got a couple days, so.
Yeah.
No, I was. It's kind of depressing though. I'm out there shoveling the snow, and it's just like this perfect white light powder, and it just makes me want to be on the hill snowboarding. Right, like it's the perfect conditions for that. So it's the worst part.
We're on a hill.
Yeah, great. You should jump on a snowboard and go down the hill.
Well, I didn't jump on a snowboard, but we actually, because we live right at the ocean, right? We jumped in. We have kayaks, so.
Oh, you did do that.
We jumped in kayaks, and like I took neighbor kids and my daughter down the hill in kayaks at super high speed and jumped the road.
That sounds safe.
Onto the beach.
That sounds totally safe. Yeah.
Well,
Father of the year.
Yes, it's true. But we honestly, the one car that went down our street, it was, it literally smashed.
He's like, I see Ryan. So he was trying to. He
tried.
Okay, yeah.
But no, he left his bumper and his fog lights on the poles at the end of our street. So no other cars are going down there right now.
No. Oh, that's nice. That's nice. Yeah.
Yeah.
Yeah, we have a park just a little bit down the road that's got some nice hills on it. So last year I took the kids tobogganing down that. I might do that later today, although I don't know. There's some hills just to get to that park. So I just wasn't sure if it'd be a good idea to be driving on the road. But yeah, I mean.
You mean you don't take your kids down hills with cars all over them in a kayak? You don't do that?
Well, I would actually be in an SUV with snow tires, and I'm still questioning whether it's a good idea.
Yeah.
Because, the
snow tires. Good times.
Yeah. Yeah. Well, I mean, as long as nobody was driving, I'm fairly certain that, you weren't tobogganing into a road where there's cars driving down. So
you're certain, but unsure.
Well, no.
I don't know if
you're
really
so certain. I don't know. If you should be so
No,
certain.
we had spotters. We had spotters, right? So
Right,
That's
right.
they were watching, but but yeah, it was. There were some
The
neighbors
spotters,
filming
were
it.
they older than 8?
No,
No, they weren't.
everybody is either.
Come on.
Everybody's over 80, so that's in
That's
the
even
area I
worse.
live in. Honestly, I think it's worse. Anyways, no, honestly, some neighbors were filming, and I swear we're gonna end up as a meme at some point here, some video,
Forcing
good that you guys
seniors
got
to stand out in
do
the
some
freezing
sledding.
cold so that you can play around. That's horrible.
Perfect. All right, well, let's get in. You did a Money Talks appearance. Michael Campbell, how'd that interview go?
I thought it was pretty
it
good.
sounded
although,
good. We heard it.
Yeah, well, no, just for the record, Ryan said that it was horrible when I talked to him the first time, which, if you know Ryan, means it was great. It means that he loves
Truth
it,
be
right?
told.
Yeah. No, I think it went really well. Felt like we kind of walked through all the main points, and this was a bit of a prelude to what's coming up in February, which is the World Outlook Conference, and the first time in 3 years that it's been a live event due to COVID.
In person.
So that's
be nice.
Fantastic. I mean, I'm, speaking in front of a camera on my computer is fine. It's a very convenient thing to do, but there's nothing that replaces getting in front of a crowd and speaking. So I'm really looking forward to that. But what we talked about with on the show, Mike and I, is just about, how are we looking at the current market environment with respect to, does it change our investment strategy? We talked a little bit about dividend growth stocks, how that strategy fits into the current environment. And then I made a couple recommendations as well, a couple dividend companies, a US tech company. I talked a little bit about our US tech research and just how really our strategy, rather than trying to predict what's going to happen in the next 3 to 6 months with the Fed, with the market, with investor sentiment, with all of that, we're building a portfolio that is set up to be successful over the next 3 to 5 years and well beyond. And to do that, we mix in some exciting themes in areas like maybe technology, still profitable businesses, but high growth, innovative companies. We mix those in with more staple names, such as some of the dividend growth stocks. And, everything that we recommend, we're growth investors. We want to see growth. But, some is a more staple, consistent, less volatile, less economically sensitive growth. And some is, that really charged innovative growth. So I felt it was probably one of the best interviews that I've done.
Yeah. And having said when we hate predictions, next week, as an FYI, we'll be making our predictions for 2023.
I don't even remember what I predicted last year.
We'll have to. It'll be fun to look back and see. I think one of my predictions on Brennan came true, though. And that wasn't in regards to the stock market, but we'll have to review that one.
Yeah,
That'll
be funny.
We'll see if that one comes through. So do you want to do your segment on dividend stocks, Aaron?
Sure. Yeah. I
get to it?
Pulled out a couple slides here. I figured I'd just walk through. So dividend investing, this has been an important theme for us for, I guess, about 12 years. When we started to do our probably even more. I mean, just when we started to do our dividend growth research, and
time flies when you're talking dividends, right?
Yeah. And well, where it really started was, in the wake of the 2008 financial crisis, we wanted to look at some names where you were getting zero return from the bond market or the fixed income market. People needed income, but we wanted to also get some stability and mix into the portfolio. So dividend research has been, a focus of ours, and there's some very good reasons for that. So just to kind of make sure everybody's on the same page, most people know what dividends are. These are income payments made by corporations to their shareholders. Generally, they're made quarterly or monthly, and they differ from bonds in that they're paid at the discretion of the company. So every month or every quarter, the company is going to make the decision whether or not to pay the dividend. Whereas a bond is the coupon payment, the interest payment. That's an obligation of the issuer over the term of the bond. So that's one of the big differences between a dividend payer and a bond. But where our focus is, as I said, we're growth investors. So our focus is on what are called dividend growth stocks. So these are companies, they're growing businesses, they pay a dividend, but they're investing enough capital back into the business that they can continue to grow and they can increase their dividend over time. So that's really what we're looking for, as opposed to just that traditional low growth dividend model where you're getting a dividend, but you're not getting much else. So there are a lot of good reasons why people should invest in dividend stocks. So one is the cash flow. A lot of people need the cash flow. Sometimes they use it as income for their living expenses. Sometimes they reinvest it, but getting that cash flow is good. But then the growing dividend as well, particularly in an environment like we're in right now, can help to offset the impact of inflation. So if you're getting a coupon payment or a dividend payment, that maybe equates to a 5% yield today, but we're in an inflationary environment for many years. If that dividend payment does not grow, then your real purchasing power from those dividends declines actually. So the growing dividend could help to offset that. Now, a lot of people think that dividend payers are just boring companies. Some people even say avoid dividend stocks completely. That's really bad advice. Even if you don't care about the dividend themselves, some of the most stable, best managed companies in the world do pay dividends. So if you, as a rule, ignore dividend companies, you're ignoring some of the best companies to invest on. And then the last point here, and this is something that I'm going to get into in the next couple slides, is that dividend growth stocks on average, they substantially outperform non-dividend payers, and they do that at a lower level of risk. So let's take a look at some of that data. This is data that is put together every year from RBC Capital Markets. And what they do is they, from 1986 to current, which the most current year, of course, being 2021 that we finished, they track the performance of dividend growers, dividend payers, and then non-dividend companies, so companies that don't pay dividends. And this is for the TSX, so up here in Canada. And what they found is consistently every time I look at this research, dividend growers substantially outperform every other category, just on an average return basis, right? So over this period of time, dividend growers are generating an average annual return of 11.2%. That would be including the dividend. And you compare that to the market average of 6.5%. So significant improvement over the market average, but then compare that to non-dividend payers, companies that don't pay dividends, 1.4%. So just an absolutely substantial outperformance between the two groups. Now, of course, these are averages. When you go into the different categories, you're going to find some dividend growers don't perform as well. Some non-payers perform extremely well. But as an average, you're getting a far higher return by investing in dividend growth stocks than you are by investing in any of these other categories, especially companies that don't pay dividends. But wait, there's more. Risk. So investing is not just about return. It's also about managing risk. So RBC also tracks the volatility, annualized volatility of these categories over the same time period. And once again, dividend growers always lead the pack in terms of, in this case, lower volatility. So volatility just being a measure of risk. How widely does a stock price fluctuate? Dividend growers annualize 13.2% volatility, less than the market average, a little bit less than the market average, but way less than non-dividend payers that are almost up there at about 25%. So almost half the risk, right? So many times the return on average, little over half the risk. I mean, it really is a conclusion unto itself. I mean, if you don't have dividend growth stocks as a key part of your portfolio, we believe you're setting yourself up at a systemic disadvantage. So this is why we think that every investor should have some dividend stocks in their portfolio, some dividend growers. It doesn't necessarily have to be all of your portfolio. It doesn't even have to be the majority of your portfolio. The composition is going to change a lot. It's going to depend on the individual, the risk tolerance, a number of different things. But the way that we see it, the dividend growth stocks, as long as you're selecting great companies, which is what we look to do, they form the foundation of your portfolio, right? So you're building your portfolio on the strong foundation, and then you're adding layers of risk to augment that return. And that can be small caps, that can be some of these exciting technology companies, maybe even a little bit of commodities as well. But it's generating the right mix of these different types of stocks, which include dividend growers, that set a portfolio up for success in the long term.
Awesome. One thing that I love to stress too is just, the effective yield, as how it grows when you purchase a stock say several years back, and that company continues to grow the dividend, that effective yield that you get to, put in your pocket. Like I know I've said this on the podcast before, but Brookfield Infrastructure, I believe if you bought it in 2011, you're getting an effective yield of over 20% on that initial capital every year that you put in to that stock. Even just with my own portfolio, Dynacor just ended up increasing their dividend again recently. And, I think my effective yield is now over 7%. So, I'm getting 7% on that initial capital that I invested in that stock every single year now. I just think it's great. It's great to see a company growing their dividend, and, slowly that effective yield grows as you hold the position.
Yeah, absolutely. It's a great point.
Yeah, for sure. And like you said, on Dynacor, they originally had no dividend when we recommended it, and then it instituted the dividend. And from like some of the the buy prices that we've had on it, it's over 7% effective dividend rate, and we expect it to continue to increase that. It really that dividend kind of compounds to higher levels over time. For you.
And it's a monthly dividend too, so it pays for my coffee every month, which is kind of nice. So.
All right. At least you don't have to pay for it yourself, right? One other thing that I should mention as well, just for information, we talked about this on the interview on Money Talks as well, is that we're in the process of putting together our 2023 Canadian Dividend All-Star Report. So a lot of really exciting companies that we're looking at through there. And this is starting off with a list of about 350 dividend paying stocks in Canada. So this is when you strip out the ETFs, the funds, some of the split corps, that's basically what you got. You have a universe of 350 companies in Canada that are paying dividends, and we go through every single one, right? So we have our current list of recommendations from our income research. So we obviously go through all of those and provide updates in the report, but we go through every other company as well. So that's potentially new recommendations. There's a couple that we're very close on. Actually, we all four just had a really interesting call yesterday with the company back east. It's a small cap dividend payer. So we're looking to add a few to our current list, and then there's also going to be about a 10 to 15 stock monitor list. So companies that aren't quite ready for our recommendation, but where we see a high probability of a recommendation over the next 1 to 2 quarters.
Yeah, and we look forward to the release of that special report, which is done annually, and there'll be some great companies in there, obviously updating companies in coverage, and we'll look to add some new companies and take advantage of some of the market declines that we've seen here. Now we can move on to a segment. It kind of Brett's going to take that. The problem of investing in concept stocks. I think it comes out of, we get a ton of questions on individual companies, some large, some small, some of the smaller companies, because we like to dig into the cash flow of the business, look at, helps us value how the business should be priced. But sometimes we get these concept stocks, very often, where you don't have an underlying cash flow. You might not even have revenues. And how do you value them? Well, let's look at some of the problems we have kind of looking at these individual companies. And Brett's going to start that.
Yeah, so what actually sparked my really look into this was Brennan's company last week. He did Drone Delivery Capital, which we just said wasn't investment worthy, but we were really saying the concept is cool, it's an interesting technology, and it could go somewhere eventually, but the company at this time just isn't good, frankly. And so, yeah, I started to look into concept stocks. So you're probably asking, what is a concept stock? It's not something you'll hear widespread. It's not like a super well-known or super commonly used term, but it is quite clear. A concept stock is a company with substantial historic losses normally, and in many cases, little or no revenue. And investors need to buy into a concept. So an idea, instead of the underlying financials, like what we like to do. So we've recently seen many high-tech concept stocks in tech, things that are commonly in AI, electronic vehicles, practically anything that Kathy would be interested in her big industries. Those are commonly concept stocks because they're just not producing revenue. And if they are, it's probably not much. She does invest in other things, I should say, but a lot of her holdings are these concept stocks. But they aren't always high-tech. Actually, quite historically, we were seeing oil and gas exploration. That's something we commonly see on our CDR sweeps right now. I know Brennan and me have been going back and forth talking about how many stocks do go on CDR. So there's thousands of stocks on CDR in Canada. If you don't know, you'll never hear about them, and for good reasons. They'll never produce any profit, but they're just eating up shareholder capital. And because what they're trying to do is sell a concept that, hey, we got this plot of land, there's oil on it. But lots of times there's not an economic amount of oil. And if there is, it's hard to extract. And for every, let's say, 30 companies, you might have one that makes it. So that's really what a concept stock is. It doesn't need to be a certain industry. It's just not profitable. And the management is really trying to sell you on an idea of future value and not current value. So another common trait of them is they're going to collapse in the short term. One of the papers which I looked at was a 2006 paper called The History and Performance of Concept Stocks. And it had a ridiculous amount of the average lifespan for concept stocks was about 3.5 years. Think about that. You're buying a stock and it's going to collapse in 3.5 years. I have held stocks in my investment life, and I am not very old compared to especially these guys here. Had to take the shot. Had to take the shot. And I've held stocks longer than that. And most stocks you're thinking about holding at least potentially in perpetuity, so forever. Concept stocks, most likely you're not going to be able to, because it's going to be sold off. The assets are going to be sold off. Your stock price is going to be a fraction of a cent and sold just to get an instant listing. So that paper, which I was referencing, let's look at historical data. That's what it really focused on. And they used data from 1967 to 1999. And on average, they found the concept stocks, which they define as the stocks with the top 10 highest price to sales. So a high price to sale means either the sales are super low, so your revenue is super low, and the price is high normally. So that's the top decile, so the top 10%, and that's what they use to define concept stocks. And those stocks over their period perform worse than the broader market. Shocker, the stocks that are collapsing in 3.5 years are worse than ones that you can hold for long periods of time. So this stock, the data they used was up to 1999, and you can see right in their data, which I'll pop up for our viewers, that you'll see a sharp turn right up before the dot-com bubble. And that's probably one of the biggest systematic increase in these concept stocks. But I would argue we're seeing those even more and more common these days. We're seeing like cryptocurrency, AI, EV, where some of them are good companies, I'm not going to lie, they have promising futures, but a lot of them, no sales or low sales and no income. So what really is the issue with these concept stocks? They can't be valued. It's as simple as that. So most valuation metrics, they'll use net income, cash, or some intermediary. So you'll use EBITDA, something like that. But all you really need to know if you're not looking into these very deep is cash is king, net income is probably second, and you'll see a various adjustments. It depends on the industry exactly. But the issue is with these concept stocks, you don't have earnings. You can't have cash flow. So what do you use? You might use sales if they have revenue. But a lot of them don't even have that. So what do you use? You'll see in the dot-com bubble, they use stuff like clicks. How does a click convert to cash? It's very, very nebulous, and you can't exactly get a good metric off of that. So they are quite, to say the least, speculative. And they'll commonly rely on, you'll see in the management, the industry is $700 billion. We're going to take 1% of that. But most of them don't. So what they have to do, they're extrapolating out, we're going to take 1%, we'll make a 30% profit margin, and we're good. We're this already should be valued at billions and billions of dollars, even though we haven't hit even a cent of profit or a cent of revenue. And of course, they'll say, hey, you just got to trust us. These values are great. We have no management experience, or we're on our 5th company in 10 years. But you should trust us, and we'll just pay ourselves some stock comp on the way. So a current example of this, which I'm not going to be as negative, that's a bit of a hyperbole, what I was just saying, but is First Hydrogen Corp, symbol FHYD on the TSX Venture. It is a company that's designing hydrogen utility vans, and they sell hydrogen as a service, which they're essentially selling the equivalent of gas pumps, but for hydrogen vehicles. And that's really what their long-term goal seems to be, is create a market with their hydrogen vehicles and then sell the pumps and the hydrogen, which they're buying off a third party, as an upsell. So the company is currently trading at $4.80 with a market cap of $238 million, and it is up 176% year to date. So it must have great financials, right? You're seeing a company go up 176%, and we're not just talking a very tiny micro cap at this point. We're talking a couple $100 million, so it at least should have some substance behind it. But no, they made a whopping $160,000 in their last quarter, or 2 quarters ago, sorry. And that's the only revenue they have ever had. That leads to an absurd price to sales, which, by the way, this number is meaningless. I'm just using it for an example. 1,486 times price to sales, which is already in my opinion, generally a poor metric. You can use it to support some things, but you don't really want to rely on it. So it's a concept stock. You're buying in the concept. They have a timeline of about over 24 months. They're trying to push their initial vehicles as some fleet tests, so they do at least have some operational substance behind them, but the financial substance, you're looking at least 2 years away, and that would be very optimistic in my opinion. And that's the problem with many of these concept stocks. It's a race against time. So like I said, they have two years. Let's say they have 3.7 million cash and about 900,000 other current assets, which is like inventory, accounts receivable. So you can normally get some sort of money back quite quick on those. You can sell off the receivables, get a few $100,000 more. So let's say $4 million. They use $6.6 million in cash over the last 6 months. So you see the problem here. They're spending. They're not bringing any cash in. But so what are they going to do? They're raising money through shares. Let's dilute our stock. They got 7.6 million in the same 6-month time period. But they have been lucky. Their price has still went up. Their share price went up. So they haven't had to dilute some. Like we see many other companies, especially those exploration oil and gas companies, they'll just dilute. And as the share price goes down, you need to dilute more. So if you're an early shareholder, you believed in the concept, your money's gone. You're going to get a 1/100th of your initial money back, even if you're right. And that's really the issue. So in summary, concept stocks are extremely speculative, have poor valuation models, and on a whole perform worse in the broader market, which is why we generally avoid them.
Well, we don't generally avoid them.
Well, we do avoid them, I should say.
Avoid them. We generally say completely.
We talk about them. That's what I was more getting at. We're willing to talk about them.
We despise
them.
Yeah.
Yeah, I mean, no, it was
on this show, we'll talk about them, but we'll never invest in them.
Yes, that's different. I mean, we might even do a star, like have a company of a star. That has nothing to do with whether or not we like the company. It just has to do with whether or not the price went up. Sometimes we'll do a star and a dog, and we actually like the dog as an investment long term. We hate the star.
Well, that's actually how I came across this company. I ran a screener looking for stars and dogs. 176%. Haven't heard of this company and has at least somewhat of a market cap behind it.
Oh, yeah.
But yeah, that's how I ran into it.
So I take exception. I take exception to one thing there, and that was how concept stocks were tracked, because you mentioned that they were tracked based on price to sales, high price to sales.
It's not perfect, but I was going to criticize myself too.
Because I think that most of them don't even have any sales.
No,
so you wouldn't be able to track on that
unless it had a zero.
It would have a zero, so I assume they would have counted as the highest bracket. That's what I was thinking that they were doing. So this wasn't a zero
ratio,
sales.
Just if they had zero.
So they were just counting that as the highest decile.
Yeah, I mean, you would just say infinite then.
Yeah, exactly.
Infinite. Yeah. Okay. Yeah, no, but I mean, I get that they have to have some type of a standardized metric, as opposed to just picking them every year. So I totally understand why they do that. I just think that if you actually calculated returns and you had all the concept stocks in there, many of which would have zero sales.
Oh, yeah.
So did they actually do that? Did they have an infinite?
I will have to look up.
Don't even worry about it. It doesn't matter.
Sure.
Just out of curiosity. So maybe they actually did. Maybe they said, this is infinite or whatever.
Yeah, it was based off the U.S. stock market as well. In Canada, we do have a lot more small caps and these micro caps.
Oh, we would have.
So I would guess we're a lot worse here.
Unfortunately, it would be 95% probably, or something not far off for the TSX Venture. A little bit better in the. No, that's good. I mean, it's something that people need to know, and I think it's good to discuss this, because retail investors get duped by concept stocks all the time. And I'm not trying to, I should actually say retail investors, institutional investors too, all investors, right? And it's, we've always said, if there's one thing that an investor can do to easily avoid risk, the most possible risk in just one decision, and that is to not invest in companies that aren't generating profitability. Right. And that's, right away. Are you going to miss a couple moonshots? Sure. You might miss, you will miss a couple, maybe, maybe not, but you're going to still be much better off, because, you don't know what those moonshots are ahead of time. So if you invest in 100 concept stocks and one of them goes to the moon, I mean, it has to go up more than 100 times. It has to go up 100 times then just to make your money back. Right.
And I think the misconception is that the only way you can get a moonshot stock that goes up, thousands of times, is by buying these absolute concept stocks, where in actuality, the only stocks that I've really seen, over 25 years have those type of moonshot returns are businesses that actually had cash flow, revenue, and earnings when they started and increased those over time. So they probably, and many of these companies like the Boyd groups that are up, 8,000, 10,000%, right? They had an actual business and traded at valuations that were lower than XYZ Mining Inc. or ABC Mining Inc. that had a property somewhere, anywhere in the world, that moose pasture that Brennan visits in Saskatoon, that's a property all the time. That same company had a higher valuation than when, say, we bought Boyd or Expel, and you don't have to take those type of risks that people think they have to make those moonshot type returns in your portfolio. You can find great businesses. I mean, even today, like Brennan just mentioned Dynacor. Well, they have a moose pasture in Peru too. We wouldn't really care about that in the valuation, but there's many companies out there that Dynacor has $100 million market cap, for example, today. They have 40 million in cash, right? So and slightly above that, but you can have that blue sky of that property. They have a property in Peru there. These many companies have $150 million market cap with that moose pasture that they're drilling sometime, or they're raising a bunch of money.
There's no moose in Peru, right?
Yeah, no, it's still a moose pasture. I don't know. That's all I call. I see that. That's
a sheep or a.
But bottom line, you don't have to take those risks to have those type of returns. So that's what we kind of try to stress to our clients all the time, and to investors. Anybody who wants to listen to it, that don't take those risks. Buy 5 or 10 stocks that have great underlying fundamentals, that have really strong growth as well. There's more of a chance that those are going to be the companies that provide you the moonshot type returns, those 2 or 3 stocks that you really need in your lifetime to change your portfolio that we talk about. As for a proxy in the Canadian markets for what concept stocks will do, I encourage you to look up the TSX Venture, look at the chart on that since the inception, essentially. I think it was in October of 2006. I'm going to pull it up here. 2,456, around that. Today it's 562. So I know it's not the best way of looking at it, because the companies that do the best, like Expel was originally listed on the TSX, then graduated off of it, but its returns, significant amount of returns before it jumped off it, were there. But anyways, if you look at the terrible returns of the Venture Exchange, which has a ton of concept stocks on it, you can see on average over time, these companies do not do well. They're just too much speculation in these businesses. Like me and Aaron always say, just if you want to have that type of crazy fun with your money, just go to Vegas and put it all in black or red, and you'll have more fun, and you'll probably have the same outcome in the end.
Not my idea of a good time, but the Vegas part sounds good.
Yeah. Some food and some shows.
Like also, I'd like to add to just on these concept stocks. It's crazy how some people try to justify these crazy valuations. Like there was this one telehealth company that I kind of got into it with this one individual that was trading at 15 times sales. And that's what, he said to me. He was like, he basically saying every growth sector in today's zero interest era is valued based on EV to sales rather than, cash flow or earnings. Yeah. He's basically saying, look at, or he says, look at every company.
Well. That statement.
Oh, exactly.
That was 7 months
and he's saying,
too.
look at the tech space, such as Zoom, Tesla, Snowflake, etc. All of these businesses.
We're looking.
High performers.
Exactly. High performers. And even this one telehealth company that I'm referring to, and I was saying, it's 15 times EV to sales. Like, come on, man.
That's good.
This stock is down over 90%. since I had this conversation with this individual.
And
so
he still thinks you're a moron for not buying it.
What about
Well,
your
I am.
review? Yeah, I'm sure he does. What about your review on Cielo Waste, which was a complete concept stock?
Exact
just
same.
same thing.
I love how it's the investors and the concept stocks that are always the most sensitive.
Oh yeah,
about anybody saying.
Told us we didn't know what the hell we're talking about.
I mean, I invest in a company that's got like
technology.
growth and earnings and cash flow, and somebody says something bad, I'm just kind of like, oh, it's producing cash flow. It'll keep doing that, so the market will,
Yeah.
But it's
Cielo went from $1. I think it's at 5 cents today, right? Well, it's just what can happen in a concept stock when people actually say, "Hey, wait a minute, there's."
And
no
that's maybe why
really
people are so sensitive, right? Because deep down, whether consciously or not, they recognize that the only thing that's keeping that up is psychology. And if you attack the psychology, then the stock goes down, and they end up looking like complete morons.
Yeah, I mean, it's a house of cards.
And like on Cielo too, like the CEO was selling at like the high of like $1.20. Someone was on the internet was coming back to me saying, no, he's actually got more shares. And then he ended up stepping down, like months after the absolute decline of the stock.
And that person still stands by their statement.
Probably. Anyways.
Good. No, it's all right. Great points.
Thanks for that segment. It was good. Yeah, now let's go to our your stock, our take segment. I'm going to look at Dye and Durham. We've got a number of questions on this company. And speaking of companies that have had, in the tech decline, had significant decline. I think it's down 67% this year. Dye and Durham Limited, symbol DND on the TSX, trades $14.08. $928 million market cap, pays a 0.56% yield. Dye & Durham is a provider of cloud-based software and technology, including legal software and data and payments technology solutions designed to improve the efficiency and increase productivity for legal and business professionals. The company is executing on a growth by acquisition strategy. So between 2013 and 2020, the company performed 13 acquisitions, grew from a few million in revenues to over $300 million US per year. Since the summer of 2020, the company has been on an acquisition spree, adding 7 major acquisitions for more than 1.15 billion Canadian dollars. And one, which I'll talk about more in a second, it chased over 12 months, will not be proceeding. The company is also now being forced to sell one of its acquisitions due to a competitive review. The sale will be of the company's July 2021 $156 million acquisition of the TMG Group. Now, perhaps the company will close a winning deal. Its balance sheet could use it, but the market now knows that DND is forced to sell this company, and M&A conditions have deteriorated. So this is something to watch closely to see if they get their money back on that transaction. Acquisition, this challenge that they've had. Well, 12 months ago, they agreed for a $2.9 billion acquisition of a company called Link Administrative Holding Limited. It's a publicly listed Australian firm which provides services to the superannuation administration industry. What is superannuation? It's basically Australian for a retirement fund offered by an employer. Now, the deal was trimmed to $2.5 billion in July after renegotiation, and once again, it did not move forward at that number. A third offer was tabled, essentially for DND trying to buy Link, just a part of Link, for a lower price, but it was rejected. Now, in our opinion, given the valuation to be paid for Link, DND may have dodged a bullet. Additionally, with the shrinking equity value in DND's stock and the higher price of debt and the amount of leverage on the company's balance sheet, the Link acquisition looked like DND overextending itself almost from the start. So let's see how this company did in its first quarter of fiscal 2023. Revenues were $120.2 million. That's up 7% from the same period last year. Adjusted EBITDA was $64.4 million. That's up 3% from the same period last year. And then net loss was $11.5 million. The balance sheet, D&D has total debt of 1.16 billion while it produces solid cash flow. This is high for a company with a market cap that is just sub 1 billion. We note the company has 878 million roughly of floating rate debt, and that debt rate, the rate on that debt, has increased significantly since it's entered into that debt in December 2021. At that time, it was likely paying in the range of 5 to 6%. Today, it's likely in the range of 9 to 12%. That will cut into cash flow over time. Our take here. On the surface, DND trades at approximately 5 times trailing cash flow, which appears attractive. But given the significant debt for this company and a company of its size, we would use enterprise value to capture this in the ratio. Thus, DND trades at around 9 times enterprise value to operating cash flow. My issue here would also center around the lack of visibility to organic growth. It's great to grow via acquisition, levering up your balance sheet, but it's a difficult game to grow by acquisition if you acquire businesses that have limited growth. Using debt to do so in a rising rate environment is even more challenging. If you generate cash flow and patiently use it to acquire, that is a different equation, and one that can be easier to succeed at, but it's actually rare to find a company do that in the public markets for a variety of reasons. Another near-term or near and midterm concern is that 68% of revenue has exposure to real estate transactions in Canada, the UK, Ireland, and Australia for the company. The company itself called out an extremely challenging real estate market in Canada in its last quarter, and this was as at the end of September 2022. The sector has worsened to a degree since that time. Finally, I will point out the company withdrew its fiscal 2023 adjusted EBITDA target, citing the deteriorating macroeconomic trends, which are resulting in lower number of real estate transactions on the markets in which the company operates. There's a case to be made with the solid cash generation of its core business. D&D is intriguing as the share price continues to pull back. But given the near-term headwinds in its market, the high floating debt levels in a rising rate environment, and lack of significant organic growth, or at least visibility on that right now, we are not buyers. We would not be buyers of DND, and we've answered that question since it traded in the $50 range and said, no, we just didn't see the value there. It's starting to be interesting. I do note too, the company did a substantial course issuer bid where it bid 150 million for its shares in this current range recently. I do question a little bit spending 150 million when you've got 800 plus in floating rate debt on the balance sheet. I know they do generate significant cash flow. It does look like a core business, which should continue to do that. But reducing debt to me would be part of the plan here. They want to continue to be acquisitive going forward too. So I don't think I'd be using my share price as a means of doing that if they think they're buying it back. But to me, adding more debt to the balance sheet is a difficult proposition too. They believe they can, but for me, in this environment, I don't want to see too much floating debt, and given their size, adding more to that.
No, that's I actually didn't know that about them, so that's good to know. I would be dead against buying back shares when you have all that floating rate debt there. Get as much floating rate debt off the books as possible. Clean up the balance sheet. That's probably going to do more for your share price and your cost of equity capital than buying back shares. I mean, the risk of buying
even
back
if it was fixed, right? Even if it was fixed, at some point it rolls over, and it's probably at a higher rate, and it's a high debt level for a company of that size, and I realize there is cash flow there, but I do believe if you're going to continue to add to that debt, paying it down as well is a good concept. So. Yeah, it's not to say that there isn't some attraction to the underlying business there. I do believe they dodged a bullet.
I don't like the growth by acquisition strategy in the technology space. Like from my experience, the technology companies that perform well over time are the technology companies. They'll do a few acquisitions, some smaller acquisitions, but it's primarily high levels of organic growth. That's what's going to get you the valuation. That's what's going to grow the business long term. In some,
The only companies that have been able to do it is where they conduct a lot of it out of internally generated cash flow, and that's a very difficult thing because you've got to get to scale
there
where
you
you're
go.
actually
Yeah,
generating enough cash flow and then do it. And it maybe came from an initial opportune raise, and then you've been able to do it. But like there's Constellation has been an example of a company
yes,
that's been able
Constellation
to
is an
walk that
exception
type
there
line.
for sure. Yeah,
Yeah, and Enghouse
Enghouse
had been
as well.
It's
Yeah,
and now they're starting to make acquisitions again. So it's starting, and you'd like to see valuations come down, but they have to have a valuation environment that is not what we saw for 2 years, right? Like they're generating a ton of cash so they can bring it in, both those companies. So it hasn't been the best environment from that. It weakens and they're probably sitting there licking their chops, right? So, I mean, like Aaron said, it's a very difficult thing to do. The companies that get the best valuations have organic growth in that sector, in the tech sector, for sure. It's totally right. All right, let's get to Brennan picking up, taking the rear, moose pasture. Get off your moose pasture and get to looking at these companies, right?
Yes, let me just share my screen here.
Ironically, these companies travel through a lot of moose pastures across the country.
They actually do. Moose pasture.
That's what you say is a segue, right?
Yeah, I guess so. So yes, this is a your stock, our take. And the question was, I was wondering if you could compare CN Rail with CP Rail in the wake of the Kansas City Southern deal. Which is the better buy now the dust has settled? So Canadian National Railway Company, or CNR, on the TSX, and Canadian Pacific Railway Limited, CP, on the TSX. So CNR engages in the retail and related transportation business and operates a network of about 19,500 miles of track spanning Canada and the US. And CP Rail owns and operates a network of approximately 13,000 miles in Canada and the US. And in the fall of 2021, CP acquired Kansas City Southern, which adds about another 20,000 miles to their track for about US $32 billion. And to pay for the deal, CP will issue, or they did issue, 262 million new shares and raised approximately 8.5 billion in debt, as well as assuming approximately 3.8 billion of KCS's outstanding debt. So the KCS shares have been placed into a voting trust until the Surface Transportation Board, or STB, issues a decision on the proposed merger, which is expected in the fourth quarter of 2022. And upon the STB approval, CP and KCS said the railroads expect to achieve full integration over the next 3 years. So right now, the company CP is reporting KCS's results using the equity method rather than the acquisition, or we could essentially call it the consolidation method. So essentially what this means, this is a little bit of financial reporting education for everyone. KCS is being reported as a one-line item on CP's income statement, as well as a one-line item on their balance sheet. So let's take a look at the actual companies here. So CNR has a market cap of about 110 billion, where CP's market cap is 95 billion. And CNR pays a dividend yield of about 1.76% with a payout ratio of 42% compared to CP's yield of 0.74% and a payout of about 24%. Now, looking at revenue, CNR's revenue was up about 26% to 4.5 billion. And when we look at CP, their revenue was up 19% to 2.3 billion. But keep in mind, KCS's revenue isn't taken into account into that total revenue number because, again, it's just reporting their income in a one-line item. So looking at the actual earnings and cash flow, CNR's was down about 11% and 14%. And the reason being is because, as most of you know, CNR was making a bid to acquire KCS, which KCS ended up terminating. And this was in 2021. And as a part of that termination, KCS ended up getting back, CNR ended up getting back about 770 million, which inflated the 2021 comparable numbers, which we're going off of. So if we get rid of that in the 2021 numbers, EPS was actually up about 65%. And when we look at CP, their cash flow from operations was up about 101%, and their earnings per share was up about 35%. And this does take into account the income from KCS. Now, looking at the net debt, CNR has about 15 billion in net debt with a net debt to EBITDA multiple of about 2 times, which is reasonable. And following the KCS deal, CP's pro forma net debt is about 26 billion. As well, they have a net debt to EBITDA multiple of about 4.2 times, which is definitely getting up there. And then just finally, on the valuations, CNR trades at a PE of about 23 times and an enterprise value to EBITDA multiple of 15 times, whereas CP trades at about 32 times earnings and 19 times EBITDA. So just to conclude, nice quick summary, given the better growth, the dividend yield, the better balance sheet, and valuations, I have to simply give the cake to Canadian National Railway, or CNR.
No, that was a good job. I like that table. You put it right beside each other. It gets right to the main points here. It's a good table. I'm glad that you mentioned the termination fee.
Oh, do you want me to pull that back up?
Impacting. No, that's good. I'm glad that you mentioned the termination fee impacting the growth, the earnings growth of CNR, because all I saw was you were just using reported earnings. And if had you not mentioned that, I was going to just tear right into you. It was going to be ugly. Yeah, I was kind of disappointed when I did hear you mention it. No. But no, it was a good summary. So
thank you.
Aaron appreciates a good table.
Mm-hmm.
It's true.
Yeah.
We all do. It's so much
I just
easier.
love looking at data tables.
I bet you do.
Good
And
table.
charts.
We'll table that for next week. Yeah. So next week we will be doing our predictions show, and the next week we won't talk to all our listeners ahead of Christmas. Merry Christmas, happy holidays to everybody out there. We'd like to wish you that. We should have done that at the start of the show when there's actually people listening, because Brennan spoke. That just killed the entire listener base at this point.
Put it into the start.
Put it at the start.
Yeah.
Merry Christmas, Happy New Year. Well, we'll have a show probably before the New Year, but and I'd like keep your questions coming in for Your Stock Our Take segment. If you got any questions that you'd like us to answer, if you've got any predictions for this year that you'd like us to read on our show and bash apart senselessly, I'm kidding. But if you got any predictions, we can go through those. We'll add those to the mix as well. Keep your questions coming in. Like I said, keep rating and reviewing us on iTunes. Smash that subscribe button, everybody. And we'll have a great 2023 going forward. I wish you all profitable investing. Thank you.
All right. Merry Christmas, everyone. Happy holidays.
Thanks, everyone. Merry Christmas.
Thanks, everyone, and happy holidays.